the value of a business, unless it's a highly levered, very economically sensitive company, is not particularly affected by the by the event of a recession, right? If you own the value of a stock, right, the value of an interest in a company, it's the present value of the cash that business generates over its life. And if it's a business that should exist forever, I'll pick Hilton, for example, we can expect that in past history, there's been a recession every 7 or 8 years. Let's assume the future is the same, and there's a recession every 7 or 8 years going forward. That's kind of factored into the value of the enterprise. The only reason why a recession destroys value is you have a company that is highly levered, and then if revenues decline, their cash flow goes negative, and they can't support their debt, and they go bankrupt, right? But if you own a very well capitalized business, I don't think a recession has a meaningful impact. It might affect that year's revenues and cash flow, but that's just one line item in a long spreadsheet of cash flows that you discount, if you will, into the present. We have a much larger number of unpaying, i.e. people who share passwords than we thought, or than we at least disclosed previously. This is causing us to reassess our business model. We're going to go to, an advertising model. And while we have enormous confidence in a management team that's done a fantastic job over many, many years, it's a completely new approach to their business. And I think for us, it made the future difficult to predict in terms of the future, what's going to happen. And we're a very concentrated investor. We put a large amount of capital in each commitment. We want these to be things that we can predict with a high degree of confidence over a long period of time. And Netflix became, if you will, unpredictable for us. So we sold it. We sold it around $225 a share. No, $275 a share. Actually, I don't remember a precise exit price. It's trading above the price we exited, but that doesn't mean it wasn't the right decision to exit for us. An investor who owns 100 stocks is a place for Netflix. An investor who owns 9 or 10, in light of the uncertainty created by the changes in how they're going to approach their market, we felt it was not something that could fit into our portfolio. In general, we like to own things for the long term. On Domino's, we actually made a profitable investment over the course of the year. Our original holding period intention was not a year, but the world changed in a pretty dramatic way. One, got a lot more difficult to get labor, a lot more difficult to find drivers, much higher interest rate environment. And the combination of those factors and the valuation that when we sold made it, in our view, just a less attractive opportunity. We'd rather deploy the cash elsewhere. So we put our capital in two places. One, we launched one of the more aggressive buyback programs out there. We're buying in about 1.5 million shares, approaching about 0.75% of our shares outstanding every month. That's a pretty aggressive program. It's about 28% of the average shares outstanding. We think that's the easiest investment that we can make right now. One, we're well capitalized, plenty of cash on hand. Two, we're trading at, as you know, a 35% discount to NAV. Three, our companies are trading at, in our view, deep discounts to their intrinsic values. You get the benefit of that double discount. So we think that's been a good place to deploy capital. The other place we've been deploying capital is some of these sort of more opportunistic hedges. We're investing a relatively small, maybe 1, 2, 2.5% of our capital in each of these various commitments, together comprising at cost, 5 or 6% of our capital, but investments where we can make 6x, 8x, 10x, and sometimes more. That seems a better use of capital for our marginal dollar than the next big equity commitment. And we've looked at, and a couple of things have come closer to prices where we would own them, but stocks haven't really gotten cheap enough for us to take our last dollar and buy the next big commitment.
During our times, who do you think is the greatest investor and why?
I hate to be boring on this. I do think Buffett is the greatest investor. And the reason why I believe that is, this is a 50-odd year, it's a 60-year track record of compounding at 20+% with a very modest amount of leverage. in the form of principally insurance float. And I just don't think there's a record that compares. And I also think that what he does actually creates value for the world. I think George Soros is an incredible investor, but I think what he does as an investor creates no value for the world. No, I think what he does as a philanthropist, I think he creates a lot of value. So I think Buffett has the benefit of, I think Heinz will be a much better business by the time, as a result of Buffett's ownership. You look at what he did with Geico since he bought it. I think he's created he's bought businesses well, but not incredibly well as he's gotten to be quite large. But he's made those businesses much more valuable. And I think he's also created a lot of messaging that's affected the way people think about executive compensation and derivatives. So I think he's made an enormous contribution. So I think it's a combination of long-term, kind of longitudinally, and the accomplishments he's had. So I think he's the best, by far the best.
Given your relationship when you worked with 3G Capital and Burger King, what was your initial reaction when 3G teamed up with Berkshire Hathaway to buy Heinz in February of this year?
My initial reaction was they're going to make a lot of money.
Just from the fact that there are 15 top-line businesses that make over 100 million, or from selling those off, or more of... No,
look, the way an interesting thing to do would be on a student trip, I don't know if you can make it all the way to Miami, but if you were to go to the Burger King headquarters, and you get off on like the 8th floor, there's no reception desk. You get off the elevator and you walk straight out, and the first desk, which is a desk you might see in a 3rd grade classroom, just a flat desk with 4 legs, you could probably buy it at Kmart or something, is the CEO. And then about 4 paces to his left is the CFO. And 4 paces to his right is the chief marketing officer. And literally the entire senior management team is in a completely open space, no offices. Behind his desk is a sheet of paper. It's got the 5 key things he needs to accomplish that year. It's got green, yellow, or red dots based on his relative progress. This is the CEO's progress. And each of the senior reports all around the office have their own metrics on things they need to achieve with commentary so that everyone can see them. The printers are all set automatically to print on both sides. You're not allowed to print color. They never allow presentations where the background is black and the letters are white because it consumes too much ink and an ink cartridge. I mean, all the executives fly coach. They share rooms at cheap hotels. If you think about that kind of culture compared to the typical big American corporation of private jets and really a lack of regard to expenses, they're just going to find, I think if I remember, the company did something like $2 billion of operating income and had something like $9 billion worth of SG&A. My guess is that $9 billion number becomes 7 in relative short order, and the $2 billion of operating income becomes $4 billion of operating income. And they bought the company with a lot of leverage. Even though it was a junk bond issue, I think they borrowed money at 4% interest. So I think the total capital structure was something like 50% debt, which was at 4%. And Buffett put up this 9% perpetual preferred stock. And then the equity was only about 1/3 of the total capital structure. So when you buy a business like that with as much leverage as they did, and the leverage is long-term and on average very low cost and safe, the 9% is a big coupon. If they can't afford to pay it, there's no penalty for them paying it. It just accumulates. And you apply a cost-driven restructuring of the company, you're going to double and triple the value of that equity over time. So I think they're going to make a fortune. And since I'm friends with them, they very nicely allowed me to invest in the deal.
When you started your MBA program, you wanted to get into investing, but there wasn't necessarily classes or a major for that. And I'm wondering, a 2-part question. First, what did you do afterwards in order to, what industry would give you the best skills to get into a position you're in now? And the second part of that is, with the rise of quantitative hedge funds and where do you see, good old-fashioned financial statement analysis and reading thousands of pages of annual reports and 300-page slide PowerPoints like you're so famous for, and really getting into it rather than these quantitative hedge funds? Thank you.
Sure. So I think the best thing, in the investing business, you can learn by reading. Read everything Warren Buffett's ever written, watch every YouTube video he's ever appeared in. That's a great way to learn about investing. But investing is more than just, the way to really understand investing is to understand a business. And one of the most important skills you need as an investor is distinguishing between a great business, a good business, a fair business, and a bad business. And one way to get a sense of the quality of a business is go to work for one. So the recommendation I give to people graduating from business schools these days is this is the greatest time in history to work for a startup. There are lots of incredibly interesting businesses being formed. And if you can be one of the early employees, you're going to learn a lot about how a business works, how to make payroll, how to market your product, how to design something. And those skills, I think, are invaluable. First of all, you might even find it really interesting. You might have joined the next Facebook, so that's one thing. Even if the business fails, you'll learn a ton from that. I think that's the best experience you can get, ultimately, to be a good fundamental investor. In terms of the future of fundamental investing, I don't think everyone can be a passive investor, and I don't think everyone can be a quantitative trader. And I think there will be always room for fundamental value investing because fundamentally stocks are driven, and business value is driven by business fundamentals, not supply and demand for securities in the short term, not the weather on certain days, and these various signals that are used by quantitative traders. I'm not saying there's anything wrong with it, but I don't think that even quantitative trading works unless there are a lot of people making fundamental investment decisions.